Today's market call is presented by Robinhood. Robinhood's financial tools put you in control to trade, invest, and earn your way. The year is flying by on this January 21st. It's Tuesday. You weren't going to fool me. I know that it's Tuesday. Any Lions fans out there, I am sorry, and I mean that sincerely. That is not sarcasm. I mean, after that regular season, I think most people that are fans of the Detroit Lions franchise thought that this was a year, maybe not win the Super Bowl, but clearly get into it for the first time in their history. But no, they were thwarted. Their efforts were thwarted by the Washington Commanders, a better football team, as it turns out, than I thought. Hello, Dan.
Hey, I'm doing great. You wanted to get into football. Let's get into the markets. I was gone late last week, Guy. I saw a little bit of what was going on here. It just earnings season got off with a bang. It was financials, and something we're gonna talk about the XLF a little bit. I detailed a trade idea to play for downside. Also thought it was a pretty decent looking hedge, and it turned out, Guy, there were no hedges needed.
You didn't need
in the banks yesterday, last week. So we'll talk a little bit about what happened there, the setup, psychology, sentiment into that, but and it kept on going. It just wasn't a one-day thing either on Thursday.
No, it's not, and obviously getting some follow through now. I think a lot of whatever market forces are out there are clearly excited about what they heard over the weekend, the potential again for deregulation, better environment, and obviously banks went to that, but let's take a look at the cues, because to me, this is sort of interesting. We've been in this channel now probably since December-ish, this down channel. We just traded to the top end of that down channel. Mm-hmm. So theoretically, this should be resistance. I was hoping incorrectly that we're going to trade down to the 150-day moving average, sort of like we did in August, again, sort of like we did in September. We didn't get there this time. Now, the question is, we're just going to continue on our merry way, because as we've seen many times over the last couple of years, these sell-offs are short-lived, and then within a few weeks, having made a new high and then a subsequent sell-off, we're right back to the new highs and then subsequently going through. We'll see. What's different this time is obviously, until today, the biggest name in the Qs, and that's Apple, and we're going to talk about how that's trading.
Yeah, I mean, I'm glad we pulled up this Q chart, because just from a purely technical basis, like you said, you see that downtrend channel. It's basically held it pretty reasonably over the last, month and a half or so. And you look at that, the upper bound there, we're right there. Now, to your point, Guy, about Apple, and we're going to talk a little bit about why it's down 4.25%. Without Apple, the thing is still acting pretty well, the NASDAQ 100, mm-hmm. right? We're up like nearly 80 basis points or something like that. I guess we come off a little bit. So about 65 basis points, but it comes back to that whole idea of the fateful eight, right? So I'm looking at my screen right now. I see NVIDIA up 2.4%. I see Microsoft flat-ish, at least it's green. It's up 10 basis points. Google's up 2%. Amazon's up 2.3%. Meta's up like about a 1%. And Broadcom's up 1.5%. You have Tesla down, and we'll hit Tesla in a little bit. But without those two names, we're acting pretty well here. So we might as well just kind of get to the call of the day, because it's not too frequently we see two downgrades in Apple. You and I have talked about it a bunch over the last, I want to say 6 months or so, that there's a fewest percentage of buy ratings on Apple that we've seen in a very long time. Now, why is buy ratings important? It's just sentiment. It's just like, considering how the sell side is thinking of it. The sell side oftentimes factor in not just their own estimates, but what they're hearing from their clients, buy side sort of things here. So here's Apple. You see that uptrend from the spring, right? You see that consolidation that we had the last half of last year. You see that slow walk higher every day. It seemed like, for about a month or so, we couldn't figure out what's going on, because to us, the fundamentals did not seem particularly good, guys. So let's talk about that downgrade. What I guess it's Jefferies and Loop, what they're seeing.
Yeah. So leave the chart up for a second, then we can go back to the slide. It was in June of last year, June 10th, I think, was that Apple event. And on that day, in the aftermath, the stock didn't really react at all. We had Gene Munster on the show that night, and he was actually quite excited about what he heard. He thought it was sort of one of the more monumental events in Apple's history in terms of what he thought for the company and what he thought for the stock. By the next day, it was off to the races. And outside of August 5th, like most things, it never looked back. I think to your point, it had nothing to do, this is just my opinion, that move from June until the recent all-time high that we saw had nothing to do at all with fundamentals. Obviously, multiple expansion and money flows that we've talked about a number of different times. Now, seemingly, people are trying to get their arms around some of the fundamentals. Obviously, I think China is a concern, but with all due respect, it's been a concern for the last 5 years, and the stock for the most part has looked past it. But I do think it becomes a valuation thing, and I just think they're running into that valuation problem that historically all companies find themselves, well, the companies that get expensive find themselves with. And I think Apple falls into that category.
Yeah, it falls into the category, but then it also falls out for reasons that you highlight all the time, passive investing, right? And so when you think of that move that we saw from early November, the breakout that we saw towards the end of the month, the kind of continuation that you saw in December, the assumption you'd have to make at that point is that the fundamentals are inflecting, that the story that got the stock going in mid-June is that you're going to have this huge upgrade phone cycle, right? Based on what they announced in Apple Intelligence. And so when you don't have the fundamentals lining up with the price action, well, if you're taking the other side of it, just makes you wrong, right? And you can get the fundamentals right, you can get the story right, but if you don't get the price action right, again, you're just wrong. So now the question is, we came back towards that uptrend. We broke through it. We're at 220 or so, which looks like the low from November. It was a level that it traded at, a few times over the last 6 or 7 months or so. And what happens now? We have a longer term chart. Let's just kind of pull that up for a second, because I think when you look at it on a 5-year basis, you probably see what I see, Guy. That $200 breakout level from last year, it's a big level. We're 220, gets to 200. You see that uptrend that we've been in, since the lows in COVID. That probably gets you to 175. That would be all the way from 260.
It's interesting. And if Timmy and or Amanda, and I'm looking at a question real quick, can pull up a question from John Hutton, you'll see it speaks to how long can Apple sort of get away with not innovating. And I think, listen, quite frankly, I hate saying this, but I think since June, that's exactly what you've seen. I think this stock price move to the upside has been on the back of the hopes of innovation, but now maybe the reconciliation that maybe that innovation is not going to come as quickly or as robustly as the market thinks. I look at this uptrend line that you've drawn and people like, there's no effing way it's going to get down there. Well, maybe not. But I will tell you, just on time decay of that trend line, that upward trend line, with each passing day, it gets a little higher. There's a chance for that line to sort of line up with that 193 level or so that we took off from back in June. That would actually make a lot of sense. And that would be then the third point of this uptrend line. So I'm not a hater. I'm not anything, but if you go back in time, you'll see now, 6, 7, 8 times over the last 7 or 8 years, you've seen 35 to 50% moves, peak to trough moves in Apple. And that's just factually true.
Yeah, I guess if you were to get down towards that 193 level, you're talking about a 25% peak to trough decline. If you get down to that kind of 175, that uptrend, you're probably getting to about 33%. And your point, we've seen plenty of those sorts of moves, but it's not in a straight line lower. That's the hard part here, and I don't think either one of us think that this is probably right here right now a great short. But by the same token, when they report next week, if they guide lower, and I think that's what Jefferies is suggesting, you're talking about revenue growth that's expected to be 5% in the quarter. And if they guide lower, you're talking about a company that's trading 33, 34 times that's growing revenues at low single digits. And so you better get the sort of innovation. And, the last point I'll just make, and we could probably move on here, Guy, is that when you talk about innovation, right, they basically avoided spending tens of billions of dollars to build their own AI models to kind of, put through their hardware, operating system, or create an operating system, their existing operating system, add the AI in it, put it on the edge, as they call it, on the device, have everything working well together. That is the Apple model. That's been going on for years and years and years, for decades, actually. And it really helped them gain most of the market share here in the US in iPhones and obviously iPod before that and the like. So right now they're kind of caught off guard a little bit because they haven't been creating their own software. And if they don't have hardware that is really innovating and, which it has not been, then you got a little bit of a problem. So when they guide next week, it'll be really interesting to see. I don't think there's an upgrade cycle based on Apple Intelligence, but who knows, Guy?
To your point, though, not pressing here, I agree with you, and I'll put this out there. And if I'm wrong at the end of the week, I'll be the first one to say it. But given the price move we've seen, I mean, it's now what, a 15% or so move
Yeah.
from peak to trough ish. There's going to be an analyst this week that takes this sell-off as an opportunity to raise his or her price target or to upgrade the stock if, in fact, they've been neutral or bearish. I mean, you can almost take that to the bank because I've seen it before, which will give a knee-jerk potentially reaction to the upside, a bit of a relief rally, maybe back to that 150-day moving average. With all that said, I want to be crystal clear. You know, I'm still one of these people that think there's more room to the downside, but I just wanted to throw that out there.
Yeah, I'm with you too, and that's a great trading kind of point that we should probably make here. Is like there was a great point above 250, maybe it's between 240 and 250 if your fundamentals aligned with a little bit of the kind of technical setup to kind of put a short on. It might have still felt like a press, but it get you down to that 150-day moving average, and then you see what we had here without the fundamentals, at least the way a couple on the street or who rate this stock, kind of found it your way, which is one of the reasons why I think, it probably works its way back towards 210. But again, to your point, Guy, it's not something you want to put a new short on right here, because as the stock gets oversold, as you get closer to earnings, it might be discounting a bit of that news, if that makes some sense.
Agreed. And we go from one call of the day. This is today's, behemoth, to a stock that was a behemoth many, many years ago. That's General Motors. And you look at this call from Deutsche Bank. I happen to like this call, by the way. They're upgrading the stock from hold to buy, a lot of different reasons. But I think this sort of dovetails with one of the comments I just made about Apple. GM's had a pretty significant sell-off. If Amanda can throw up the chart, you'll see what I'm talking about. And we actually traded down to that 150-day moving average. So, it would appear this analyst, if they're playing stock market, maybe they missed it by a couple days, but I think this sell-off is given reason for some people, given some green light for some people that have been negative or neutral, having sort of watched this thing in some ways defy logic, given what Ford has done to the upside, GM to the upside, Ford nowhere. I think this is giving some air cover to sort of upgrade the stock. I'll say this, I do think there's a chance, given this sell-off, given where we held, we could sort of levitate right back to the levels that we saw in November or so. And I think that was about 62.5, 63.
Yeah. Who caught that? Guy just said the green light. I thought that was kind of interesting for a guy who doesn't like to have cheesy little comments.
It was, red light, green light, 1, 2, 3. Did you play that game as a kid or no?
I don't know.
I saw that. You know what? I used to play because we didn't have like all the fun stuff that you kids
TVs
have
and radios.
So we'd go outside and actually do things. But apparently, there's this Netflix show, the Squid Game. You see this?
I would never watch that.
They play red light, green light, 1, 2, 3
for their lives.
For their lives. We're not playing for our lives.
All right, let me go to the Robinhood legend guy. I'm going to be a bit of a legend here. I want to take a look at this GM because I see what you see on the chart, and so that was Amanda's chart that she just. This is my screen right here. Let me just go to a longer term chart here. Okay, you see this and you see that uptrend. That's the 150-day moving average. You see the downtrend from those recent highs. You just mentioned it, probably 61.5 or 61-ish to the upper end of that. And so if you get a little bit of a technical breakout, we know we have valuation support. If the analyst is basically saying some of the competitive issues are kind of worked in here, that EV tax credit that is likely to go away. Elon Musk's point is going to hurt some of their competitors more than it's going to hurt them. Well, we know that, GM and Ford have already moved away from some of their, their focus on electric vehicles. They moved more to hybrids. So when I look at this and I say to myself, the implied move in the options market, this company is going to report, I think, let me just get the exact date for you, Guy. I think it's the 27th of February. So that would be next Tuesday or so.
January.
Yeah, or I'm sorry, January 28th. And so I look at this thing and I said, okay, let's go to the options chain here. Let's look at, January 31st weekly expiration. The stock is trading, let's call it around 54, right? Well, what am I doing here, people? How do I figure out the implied move? I take the at the money straddle, right? I take the call premium, I take the put premium. It's in January 31st. That's the week that it's going to report earnings. So the 54 straddle, again, call premium plus the put premium, let's just call it around $4. You take that $4 in premium, you divide by the strike price, it gets you about 7.5%. Now, if you were bullish and you just wanted to kind of make a defined risk, directional, here you go, around 190, that would be your risk. You have actually between 54 and 190, you'd have losses above 55.90. So it's the strike plus the premium, 190, 54 plus 190 gets you to 55.90. You would have gains above that, but you have losses up to 190. So it's about 3.5%. I don't really love this guy on a directional basis, unless you have a lot of conviction. Now, the other way to use short dated options, if you have a long position or a short position, is basically give yourself a little leverage. You know what I mean? And so you could also make the case on the flip side. Let's say you're long this stock, guy, and let's say that 7.5% move, let's say that looks kind of interesting to you, right? Maybe you go out and you sell those weekly 56 calls against the long stock. So again, when we're looking at trade ideas, we look at it in a few different ways: long or short the stock. What is the vol telling you? Is it pumped up? Is it create a great buying opportunity because it's cheap, or a good selling opportunity against the long because it's expensive? So when you see a 7.5% implied move, guy, into a GM earnings event, it's probably not calling your name, I would say, a little bit.
No, it's not. But if you put the legend back up real quick, to your point, if you're long this stock and you want some sort of synthetic dividend into earnings, understanding that by selling a call, by being long the stock, you will give away whatever upside there's above that call strike price and the premium for what you're selling it for. But that's actually, I think you're getting paid a decent amount here, sort of $1.05, $1.10 to sell those 56s that expire the end of next week. Again, you give yourself a little synthetic dividend. I think a lot of people say, you know what? I'd be happy to be called away at the stock at 56-ish, understanding that you've also earned the dollar by selling the option. Now, I just said it's going to 62, but to your earlier point, it's not going to probably do that in a straight line. So I do think this is sort of interesting.
Right. So to your point, let's just say the stock's 54. Let's say you look at that 56 strike, you sell that call at 110. Basically, you would have gains up to 57.10, the strike price plus the premium that you sold it at. Now, Guy's point is a good one. He said, all right, on the chart, maybe it looks like 62. Well, then maybe we go out to February expiration. So that's the third Friday of every month to have the regular way, right? So here's February expiration. Again, stock's just below $54. If you want to look at that 62.5 call, 34 cents, not worth it, right? 62 strike call, 38 cents, not exactly worth it. I mean, maybe you get to this 60 strike, guy, and that is 64 cents. It's a little more than 1%. As a rule, you don't want to, like in an overwrite on long stock short call, you don't really want to go below 1% of the stock price.
I agree with that. I think that makes a lot of sense. And again, each situation is different, right? It's not just formulaic, so you have to sort of evaluate on a case-by-case basis. But we're looking at General Motors. We just said traded down the 150-day, having sold off from that 62 level. We're bouncing here. This is something to look at, especially if you are long the stock and you're looking to create a little bit of a cushion for yourself. Makes a lot of sense.
Yeah. And again, you know what? This is one of those names that also might make sense to just kind of wait and see what they've said on the earnings front, because I don't have a lot of conviction one way or another, but it could be an interesting setup after the fact based on how the stock reacts to what they told us about guidance going forward. Let's go to earnings, guy, because we have a whole bunch of them.
Who did this? That's a good looking slide.
That was all Amanda. That was all Amanda.
She's feeling better, by the way. Hopefully you folks reached out to Amanda. She was a little under the weather. Anyway.
Yeah. So we're going to get to airlines in a second. One of the things I think is interesting about Wednesday, that would be tomorrow, Procter & Gamble. We looked at the staples last week. We talked about how weak they were. Maybe it had something to do with a strong dollar. Dollars come off a little bit, but Procter & Johnson & Johnson, two of the largest holdings in the XLP, the ETF that tracks consumer staples. What names stick out to you here, Guy?
Well, I'm going to leave the airlines alone because the American Airlines is something we will talk about in a second. I think you're right to bring up Procter & Gamble. And by the way, that dovetails with a question we have. I think it's John Hutton again about the weakness in the dollar. So, this all plays into what you're saying. If you want to throw that question up real quick, the dollar has been strong until obviously today specifically. And I think a lot of it has to do with what people heard over the weekend in terms of tariffs. And I think there's some sort of interpretation that maybe they won't be as severe or as vigorous or happen as quickly as the market sort of thought. And I think the sell-off in the dollar, in my opinion, is probably based on that. I'm not one of those people that think this is going to last all that long. I still think there's going to be weakness in the bond market, meaning yields are going higher, by the way, which is the same trade as the dollar. And I think that dollar weakness that we're seeing today is going to be offset at some point. So I do think the rhetoric around tariffs is going to come back, which, going back to Procter and Gamble, one of the reasons you've had these headwinds is on the back of a couple things: the stronger dollar and the fact that they've no longer been able to really pass their cost on to the consumer. So their margins have been deteriorating. And I don't think that trend is going to stop anytime soon.
Yeah, that was one heck of a sell-off, though, in a Procter. One of the things that I thought was really interesting is like what rallied after the election, what gapped up on that November 6th and kept on going. And we saw this in like energy names too, Guy. Like they had these really quick, straight up moves, and then they probably took a month and a half, not only filling in that November 6th gap, but making new lows. So consumer staples seem a bit oversold, just like we thought the XLE was a bit oversold and had that bounce that we were looking to play for. So it'll be really interesting to see how Procter and Johnson trade after they report earnings. Right. But if Amanda wants to go and make that a one-day chart for a second here, you see that we were up a bit more on the open today. And then here, let's go to a one-day. And you see that we've been kind of selling off a little bit, after that opening. So interesting price action in these staples. Guy, what about some of these financials that we're going to get that are left over? And so when I say financials, I really mean American Express and Discover, and what they might tell us more of a pure play than what we heard out of money center banks, investment banks last year, pure play in the consumer.
Yeah, no, it's interesting. American Express, I mean, let's throw up that chart real quick. I think it's trading about 318 or so. I want to say the recent all-time high is 319 and change. So I think it made it today, by the way. I thought it was last week. It was today. So here's a stock that seemingly defies gravity. And by the way, not that it matters all that much, but this was basically a $150 stock, I want to say in November, December of 2023. So it's doubled over that period of time. And maybe it's justified. This is what I will say, though. If you're one of these people like I am that believes that credit is going to come into the equation at some point, American Express is obviously a company that takes credit risk. And, we haven't seen it yet at the higher end, but I do think it's just a matter of time before we do. So it's gotten itself a little bit expensive on valuation. They're probably going to say everything the market wants to hear. So I think this probably trend continues to the upside, but I think you're looking for a level to pull the ripcord here. And then obviously vis-a-vis options, potentially play it for a downdraft at some point. I just don't think we're there yet, Dan.
Yeah, and again, it's really important to differentiate. You'll hear on TV a lot of folks talk about the financials. There's a lot of different financials, right? And you can't just lump them all into one. We talked a little bit about the XLF last week, that it's not a perfectly constructed ETF by any means, with Berkshire Hathaway being the largest holding. And so when we were looking at this one last week, I was looking at the Jan 24th weekly guide. That would be this Friday, the 47.5, 45.5 put spread. It cost about 35 cents. That was a $2 wide. And let me just kind of take over the legend here for a second so we can kind of take a look at this name. Because again, what are we trying to do? We're trying to use options in a way where, we are defining our risk to kind of make some sort of calculated take some calculated view. In some instances, it's just feels like taking a shot at something that maybe you don't have a lot of conviction on. In this one, we're like, what? The technicals were probably lining up a little bit with what expectations were. The stock ETF was acting pretty well. Expectations were high, heading into that, but we also saw a little bit of technical weakness. And so the ETF was trading last week when we were looking at this trade at about $48. Well, here we are. You see it 50.5 or so. And I'll just kind of show you what this looks like right now. If we're looking at the 24th, it's the 47.5. You got to go all the way down here. So it's basically worthless. Okay, the 47.5. Now, we talk about using a mental stop, 50% of the premium spent. This one really didn't even give you the opportunity to do so because of the gap that we saw on Thursday in many of the names. But you were paying 35 cents for a $2 wide, kind of near the money with a lot of events there. And, risking 35 to make 165, if you have conviction and you get a couple things right and you have 2 weeks for it to earn out, that's not horrible. I'm just curious though. I mean, I'm not trying to justify a bad trade. Bad trade's bad trade.
It's a 5-to-1, 6-to-1 with all the events coming up. You had a directional view. No, I mean, it's a trade. I think, look, I mean, you wouldn't do it again, obviously knowing what you know now. But with that said, it's a trade. The way the setup was, I think you would do day after day, because more times than not, you're probably going to wind up being right. And the risk reward set up really well. And that, by the way, leads us to a question that we have from Adam B. How tight do you have to stay? How tight do you set the stop loss? Does it vary by stock? And, one of the things I said earlier about things not being formulaic, the same thing goes with stops. I mean, you can't just say it's going to be a 10% loss and I'm out. Dan does that with options 50%, but that's a little bit of a different animal. In terms of individual stocks, a lot of times it has to do with chart level support, resistance levels, and those types of things. So I think it's a case-by-case basis. But I'll also say this, you have to stick to your guns. And one of those things I say, it's really important, obviously, your entry point, but almost as important as your entry point is to know where you're getting out if you're wrong. And that, by definition, is what a stop is. So you have to be disciplined, and you have to sort of set those levels based on things you're looking at. It might be an RSI level. It might be, again, a trend line, a chart point, a resistance and support level, but it's different for every single trade, Dan.
Yeah, and you just mentioned the difference between trading, a single stock or an ETF on an outright basis versus, an options trade. We just gave an example where the trade basically went pretty worthless. I guess it felt a little binary. That's not the case when you're long or short a stock or an ETF. But the thing that you have to worry about is that, let's just say, you were short the XLF last week and it, rallies, let's say 10% in a couple days. Are you letting a trade turn into an investment or a longer term trade? You know what I mean? That sort of thing from a short term trade. So those are things you want to consider.
Mm-hmm.
I always like to use mental stops because the last thing I want to do is keep averaging into some name and hoping that it gets it right. All right. We talked about the airlines, and this is a group guy. We looked at the jets, I want to say about a month or two ago, and it just seemed with oil rising the way it was, with some of the consumer data that we were seeing, that maybe the airlines, and specifically Delta and United, after some massive moves, were ready to take a little bit of a breather. Now, that has not been the case. Maybe Amanda can pull up United and Delta, and when you look at these sort of parabolic moves, I don't know, it's got to make you think a little bit twice about those names in particular. Let's go to a 1 year really quickly on that one. And man, look at that. I mean, It just went from being basically in the shitter in the summer. Let's go to a 5-year chart really quickly before you go to you could go to 5-year, either one of these. I mean, it's just, when you see it in that context, I mean, you have this long consolidation. This is United, for a couple of years, and that sort of breakout. I mean, what is that saying to you, Guy?
Well, it's interesting. I mean, it says to me that people are excited about the economy in 2025, the potential for more business travel in 2025, the hope that energy prices are going to be lower in 2025. I mean, those are three things right off the top of my head. And obviously airlines wins all of that. And it's interesting we mentioned these two. If you watch Fast Money, and, again, I'll say it, I'm wrong all the frickin' time, but something we got right recently, and it, by the way, I sort of stumbled onto it, was American Airlines. So put up an AAL chart, because I do think that's one of our charts of the day, if I'm not mistaken, or something of the day, calls of the day, something of the day. But what we said was, I saw an analyst, I think it was 2 weeks ago, on with Kelly Evans. She was from Jefferies, and she was pointing out how American Airlines had been in these low margin businesses, and they were going to start to pivot some higher margin stuff. And I thought we were about to see some bearish to bullish reversal. And lo and behold, here we are. Now we're through that downtrend line. So the one that can actually play significant catch up here is American Airlines AAL, Dan.
Yeah, before we get to the fundamentals, let's take a look at the 1 year chart we have, and then we'll kind of toggle back and forth between that 5 year. I mean, the 1 year just kind of puts it in, that huge breakout. Okay, that was after the election. You see that volume that it had. It checked back to the breakout level and kept on going. And I think that's what you're kind of thinking about, or you just suggested this bearish to bullish reversal. Now let's go back to that 5 year chart. This is quite possibly, one of the nicest looking breakouts of a downtrend I've seen a long time. So we just talked about that breakout on big volume. You see that massive double bottom from 2020 to these levels. And so now you have this kind of little flag forming with a big island. And, I'm saying to myself, next stop, probably 21, 22, and so looking at earnings, they come out next week. We've already seen some good results from Delta United that got this thing going. I think actually the earnings are on the 23rd. So here we are on the 21st. So that would be Thursday. I wanted to price out up a call spread guy and kind of look to define my risk. Let me drive at the legend here again here. And so we looked at those levels here. I want to go to the February expiration. Where are we? February 21. So that's regular way. The stock is trading about 18.5, right? So I wanted to look at the 1921 call spread here. So that cost me right here about 57 cents. I priced it up. It was about 55 cents before we started the program here. So if you're buying one of the February 19 calls, let's say you paid 80 cents for those, and let's say you're selling one of the 21 calls in February, let's say that we sold those at 25, that gets you to that 55 cents. Amanda will she'll flag that the payout diagram that we have right here. So you're basically paying 55 cents for a $2 wide. I'm looking out a month and I have a catalyst. So I'm risking 55 cents. So if I take the strike price, 19, plus the premium I paid, 55, your break even's at 19.55. The sell of the 21 call in February, that is your max gain up there. So you can make basically 145, okay, between 19.55 and 21. So I like that risk reward. It's basically a 3-to-1 payout here, and my break even is near the money. I'm looking to play for a continuation in these gains or a further breakout. Now, the one last thing I'll say is I'm putting on a call spread, rather than risking that 80 cents. I basically am capping my gains, and it depends how bullish you are. It depends what you think is going to happen, because you also have, another month until February expiration. This is not one that you can kind of leg into because we have the event in about 2 days.
I agree with that. I like this 3-to-1 risk reward. There's probably a decent probability that this trade's going to wind up working to your favor. So you got to sort of take that into consideration. And just in terms of what we talked about earlier, with the fact that American Airlines has been such a laggard for so long, and they're seemingly turning things around. I mean, I'm of the belief that this is going to work out really nicely for you. Now, some people will say, well, if you're so convinced, you can just buy the stock. Yeah, you could definitely just buy the stock. You want to do it vis-a-vis call options or with a spread that sort of mitigates some of your risk. I think this is an interesting way to do it.
Yeah, and I just want to touch on one other point you said, some of that low margin business. I think that probably came around the time where the CEO of American basically said they're going to focus on, really kind of drilling back into a lot of that higher margin, business travel and the like. So let's see what they guide to when they report in a couple of days. One last thing, if we can go back to the options train, you said there's a pretty decent probability that this is, in the game. How do we figure out what the options market is kind of assessing a probability wise? So here's February, here's the 19 strike. I go over and I look at this delta, and it's about 45%. So that makes sense because I'm basically very near the money, right? So it could be 50% down, 50% up from that. That's the probability of that. But then in this instance, I'm paying 55 cents for this call spread. I'm going to look at that 19.5 call, and it's showing me about a 37% probability of being in the money. Why am I looking at the 19.5? The 19 strike plus the premium I paid, that's going to give me a rough estimate, Guy, of what the likelihood of this being in the money is on February expiration.
And I think given that math, I think this is a trade, again, you do every single day. You're searching for trades like this, and I think this is a trade you'd put on every single day. Again, it doesn't guarantee that we're going to be correct with this one, but you're trying to sort of level the playing field and stack the odds in your favor, and with some things that are known and obviously some things that are unknown, which is why options make such an interesting way to do it, because you can find sort of interesting opportunities like this if you're dig enough and if you're curious enough.
Yeah, last point, just from a risk management standpoint. So risking 55 cents, that's the price of the $2 wide. Just looking at this chart right here, and this is kind of give you a sense why you might be doing what you're doing, right? So this is probably, you see this candle right here. Okay, so if the stock were to go down, 55 cents, that's basically the equivalent of the premium that you paid. There's still going to be some value in it, especially if you have, a few weeks to expiration. But you're basically, if the stock is at 1850 right now and you pay 55 cents for, a 1921 call spread that's out of the money, you're basically risking down to about 1795. You know what I mean? Like that's basically where you're stopping this out. Now it's different if you're just long the stock, but I just want to make that last point, Guy. I don't want to belabor the American call
No,
spread.
no need. Real quick chart of the day is Netflix. Should come as no surprise to report after the bell today. I mean, this is a stock that outside of a huge downdraft a couple of years ago, like a lot of things, I mean, it's been basically on autopilot. We've sold off a little bit since the all-time high we made, I don't know, a month or so ago. Personally, I think the setup is pretty good in the earnings. I mean, there will be people that say, you know what, you're going to have an event where, this downdraft we've seen before that might take us to the 150-day moving average, which I think is about 765 or thereabouts. But, if I'm looking in the here and now, given the recent sell-off we've seen and given some of the things that they've done and some of the enthusiasm around events and stuff that Netflix has stumbled into, well, I shouldn't say stumbled into, gotten themselves into, I think it's sort of interesting right here.
Yeah, I'm less excited about it, Guy, because I think the point that you just made about events, it's really sporting events, right? So they're starting to bid for sports rights. You see the way that they are just ticking up, right? And so they had 2 NFL games in Q4. They had the Tyson fight. There might have been a couple other things that might have driven subscriptions in Q4. But when I think about just some of the price increases that they've had, I think about they have to keep it up with some of these sporting events. I think the guide for Q1 and maybe what you're able to extrapolate, out for the balance of the year, I think it probably comes in less than some folks expect. And under that, scenario, I could see this stock, below this kind of 800 level, maybe working its back towards that, 150-day moving average. And again, it's not that expensive a stock, but you're starting to see some of these estimates on both earnings and sales kind of decelerate a little bit, except that margins are moving higher. And so I guess that's probably the real bright spot. It's gone from 41.5% gross margin to an expected, I think, 47.25% next year. That gets you to that really nice profitability, also pure margin. And a big part of that might be the price increases that they put through, which probably slow down a little bit into the new year.
We're going to find out in about less than that, 3.5, 4 hours. Real quick, we have a few questions about Oracle and the news that just came out within the last hour or so that got the stock from about 164 up to 170. I think you're going to see more and more headlines like this around this new administration. We've talked about winners, losers, technology. Well, today it looks like Oracle's the winner. And what do I think about it? Well, this is what I think about Oracle for a while. I thought it was one of the better technology plays for the last few years. One, you could at least make a compelling argument on valuation. And, the stock recently made its all-time high. We sold off again, like we have a number of times over the last year. If you go sort of longer-term chart, you'll see we basically got down to the 150-day moving average. We traded through it. I get it. But, we're bouncing at levels that we bounced off of before vis-a-vis that moving average. So, I would have said I liked it prior to this. I think this is just one more reason to like it. So I think Oracle continues to win in this environment. Dan.
Yeah. It's interesting to me that, before this announcement today, you saw that gap. Maybe Amanda can pull it and make it a 1 day or 1 year chart, excuse me. You saw that gap, right? That was after earnings. The stock kept on working. Then you have the, election. It keeps on working. But then you have guidance that comes, I want to say in mid to late December, and you see that gap lower and the stock kept on going lower despite what the NASDAQ was doing. They're basically, their cloud business is slowing a little bit. They're not taking as much share as some folks thought they would. So when you hear a headline like this, okay, it's that basically there's going to be this new joint venture that Trump is going to announce between OpenAI, which we know is, the backer of or the maker of ChatGPT, and it's an infrastructure play, right? So if Oracle is going to basically be the cloud infrastructure for this, and you're doing it with OpenAI, and you also have SoftBank involved. SoftBank has already said that they're going to invest $100 billion in the U.S. I think that came out a few weeks ago. let's see what these projects, let's see what the timetable is for these sorts of things, because we saw this under the first Trump administration and we just didn't get a lot of traction on a lot of these things. I get it.
Yeah.
There is a huge push to get this infrastructure done now, but it might not be from A to Z as quick as some people think.
Listen, 100%. This is not, my bullish view on Oracle has been that way. This is just sort of fuel to the fire, but your point is well taken. There are going to be a lot of headlines like this over the next couple of weeks that you're going to see moves of this magnitude. I'm not going to pretend to know what they are, but they're going to be winners and losers without question. But Oracle obviously is everybody's all-American today. With all that said, Dan, that's about it. We had a couple questions about the dollar. I think we addressed. Yields falls into that camp. But we'll be back tomorrow. As you can tell, I'm all knotted up, so I'm headed into CNBC's Fast Money for the first show of the week.
I am too, Guy. I'll see you up there at the NASDAQ. We really appreciate you guys being here. We got more to update for the rest of the week. We're really going to get geared up for next week because it's going to be all those mega cap tech earnings. Let's see what they have to say. I think for me, one of the more important things is going to be CapEx. When I think about how much these companies are going to continue to commit towards building out their AI infrastructure or training their models or whatever the hell else they do in that endeavor. But to me, next week, the Fateful Eight, Guy, that's going to be the big one.
And we'll be doing a few shows from the iConnections conference in South Beach. So be on the lookout for that, peeps.
Yeah, we're going to be doing market call from down there Monday, Tuesday, Wednesday. You and I are going to be back in the office on Thursday. And then Tuesday and Wednesday night, Fast Money from Miami. That is going to be a lot of fun for our friends from iConnections.
Looking forward to it. Thanks for joining us, folks. We will see you. I don't know if BYT is with us tomorrow, but if she is, it's going to be great. See ya.